Hi, I'm Thomas. This is the course Financial Principles and Project Cost Management, and today's topic is Managerial Accounting. One concept we'll look at is CVP analysis, cost volume profit analysis. This is a way of analyzing a company's cost structure based on whether costs are variable or fixed, and we're going to make a simplifying assumption, which is that all costs are either fully variable or fully fixed, which isn't always the case. And another simplifying assumption is that we will define variable costs as any costs that change when the number of units sold changes, and we'll define fixed costs as the expenses that do not change when sales levels change. Here's a group of formulas that are important for CVP calculations that we'll see examples of to follow. Contribution margin ratio, operating profit, all relate to numbers that are in the income statement. And break even, either in units or in dollars, is a concept that helps us understand what is the lowest level of sales that we can achieve and not lose money. Break even means exactly zero profit. That wouldn't be our goal, but we do want to know so that we understand for planning purposes and managing potential downside, what's the lowest level of sales that we need to ensure we're not losing money. Now, in an example, we have 4 data points here: our sales price, the planned unit sales, variable costs per unit, and fixed costs. Notice that variable costs are described as per unit, and that's an indicator that as we sell more units or fewer units, total variable costs will change, whereas fixed costs will not change. Now, looking at our calculations, first, contribution margin per unit. Note this is on a per unit basis. This is our sales price minus variable cost at the unit level. Then the contribution margin ratio, which is the contribution margin per unit we calculated above, divided by sales price per unit. And operating profit is sales minus variable costs, which gives us contribution margin as a subtotal. Notice this is not described as per unit because it isn't, it's in total. Contribution margin minus fixed costs equals operating profit, and the formulas for these calculations are on the formula slide we saw previously. Continuing to break-even sales. Break-even sales, again, is the concept of the sales level at which we have exactly zero net income. So to calculate our units of break-even sales, the calculation is fixed costs divided by contribution margin per unit. Notice it's not the total contribution margin, rather per unit. And to calculate break-even sales in a dollar amount, this is fixed costs divided by the contribution margin ratio, or simplified calculation. We have calculated break-even sales in units in the top part of the slide. If we simply multiply that number by our sales price per unit, then we'll arrive at our break-even sales in dollars. Now, the two break-even sales dollars numbers are slightly different. This is due to rounding, but for our purposes, these can be considered the same correct answer. Here's a cost volume profit exercise you can work through on your own. The same form or type of data given, just different numbers as in the example, and follow through the example process to calculate contribution margin per unit, contribution margin ratio, operating profit, and break-even sales in units and in dollars, and we'll work through this example in class together as well. Our next topic is flexible budgets. The flexible budget is a step beyond a normal budget because it allows us to factor in a change in sales units. When we plan on selling a certain number of units and we sell more or fewer than that number of units, that naturally has an impact on certain components of, not all components, but certain components of the budget, and building in a flexible budget between the original budget and the actual results helps us to fine-tune our analysis and get more understanding from our results. Let's start with a budget example. At the beginning of our period, we have a plan for the number of units we'll sell. Our sales price per unit in the formula column is $40. Our variable cost per unit is $10. And fixed costs, $9,000. Notice there is no Q next to fixed costs. We're not multiplying fixed costs by the quantity. Regardless of quantity, fixed costs are the number that we're budgeting. And we have a planned net operating income as a result of this budget. Now, when we compare the budget to actual results, we can see, without looking at every item on the screen, if we look down at the bottom, we see net operating income has an actual result of $4,950. This is better than or favorable, abbreviated with the letter F, favorable to our plan by $1,950. Now, what we don't know is, why did the result show as favorable? What are the factors that drive that favorable result? It's a good result, but we want to understand what happened. Some parts of it might be good, and we want to continue to do those parts. Other parts might not be good, and we want to change those activities. Notice at the top of the screen, we planned on selling 400 units. We actually sold more. We actually sold 450 units. And the difference between those two numbers is the central component of the flexible budget. In analyzing the budget, it's natural, it's logical that some numbers will change. The variable numbers will change when we sell a different number of units than we planned. Other numbers that are fixed, that aren't driven by number of units, shouldn't change. But when a variable cost changes or total revenue changes, that might be because of the change in units. That might be because of other reasons, which we're going to see as we look in more detail at our flexible budget process. Activity variances are solely based on change in units from the original budget to the actual units sold. So we're going to now make a comparison between the planning budget that we created at the beginning of the period and what we will call the flexible budget. Now, the flexible budget simply replaces the number of units in the planning budget of 400 with the actual number of units sold, 450, and we use the same formulas that are in red on the left side of the screen: the sales price per unit, the variable cost per unit, and the fixed costs. Now let's look a little more closely at what's happening in the activity variance column, where we see the red letters. Our sales went from 16,000 planned to 18,000 in the flexible budget. More sales is good, so we label that $2,000 difference as favorable. When we move down to variable costs, the change is an increase from 4,000 to 4,500. We don't want expenses to go up, so we consider this unfavorable, described as U. Fixed costs are the same in both cases, because no matter how many units we budget, fixed costs in the budget won't change, so there is no difference for fixed costs. Our total expenses are $500 higher than planned, which is unfavorable, and our net operating income is $1,500 higher than planned. We like net operating income, so that increase is favorable. Now, there are other variances that we factored out in the prior slide, and we want to isolate those variances now. They're called revenue and spending variances, and they're driven by changes in sales price per unit, changes in variable costs per unit, and changes in fixed costs, regardless of change in number of units sold. So now I'm looking at the flexible budget. That's this new column that I built in the previous slide, and comparing that to actual results. Notice that the top row shows the same number of units sold, so we're taking out the change in units component, and we're only looking at changes in prices. I see sales is 18,250, which is 250 more than or favorable to what I expected. That means that I had a higher sales price than $40 per unit. Variable costs has a favorable variance as well, and that means that the variable costs must have been less than $10 per unit. Fixed costs has an unfavorable variance. The fixed costs were $9,600 in the actual income statement. That's $600 more than we had budgeted for fixed costs. And total expenses were $200 less than what we had planned based on the flexible budget. That's favorable. And our total end result net operating income, $450 better than or favorable to what we had originally planned. So what we've seen in the flexible budget analysis is we can create a middle column, the flexible budget, which uses one number from actual results, which is the actual units sold. All other numbers, whether formulas or cost budget or sales price per unit budget numbers, they all come from the budget to create a new column we call the flexible budget that is based on the actual number of units sold and the budget rules from our original budget. By creating that analysis, we can look at what drives the difference between the budget and the actual results as a component simply driven by change in unit sales. That's the activity variance. And another component that is driven by change in pricing, and that is revenue and spending variance. When we combine all of this information into one report, it's called the performance report. And here on this slide we have our performance report. No new numbers, simply combining our analysis into one slide. We're starting with our formulas on the left side of the screen. From the formulas, based on a planned unit sales of 400, we create our planning budget. In the middle of the analysis, we have calculated the flexible budget based on 450 units, which came from the actual units sold. In between planning and flexible, we have the variances that are solely based on change in units from budget to actual. And then to the far right, we have our actual income statement. And between flexible budget and actual is the revenue and spending variances. These are the differences that are isolated from the change in planned versus actual unit sales to solely look at what changes occurred in our sales price, in our variable cost per unit, and in our fixed costs. To make this process work, it is important to keep 2 points in mind. One, variable costs change when sales levels change, and fixed costs do not. And it's also important to keep in mind that the difference in activity variance and revenue spending variance is that the first is based on the difference in planned versus actual unit sales, whereas the second doesn't take into consideration the change in unit sales. That's factored out. The second, the revenue and spending variance, is only looking at changes in planned versus actual sales price per unit, variable cost per unit, and fixed costs. And now we'll work through a flexible budget exercise. We have data for our budget at the top of the screen. We have actual results reported in our income statement at the bottom of the screen. And we can use this information to create our performance report. We'll build our planning budget. We'll build our flexible budget. We already have the actual results, and we'll calculate differences to arrive at the activity variances and the revenue and spending variances. You can take a look at this ahead of time, but we will work through this activity in class together. The following slide is the template we'll use to complete the activity. This ends the lecture on managerial accounting. Be sure to be in class for our activities as well as our case study analysis, and I look forward to seeing you then.